market expectations of a pause by the Fed appear to be increasing, which may incentivize investors to reallocate funds to the precious metal. In addition, we note that external shocks in the gold market appear to have all but vanished, with financial releases stemming from the US to be in the spotlight. In this report, we aim to shed light on the catalysts driving gold's price, assess its future outlook, and conclude with a technical analysis. The precious metal during today's trading session managed to print 6-month highs as the market anticipation that the Fed may have reached its terminal rate appears to have been growing over the past week. The anticipation that the Fed may be done with rate hikes appears to have aided gold's ascent given the precious metal's inverse relationship with the greenback. However, when we compare gold and the dollar index, it appears that the relationship may be disproportional, yet nevertheless still remains present. As such, despite optimism that the Fed may be done hiking interest rates, gold's ascent may be attributable also to other factors explored in this report. This week is expected to have key financial releases from the US in terms of the Core PCE rates, which is the Fed's favorite tool for measuring inflation. The Core PCE rates for October are expected to come in at 3.5%, which is lower than the year-on-year basis if compared to September. Therefore, the anticipation that inflationary pressures may be easing could be preemptively generating market optimism that the Fed may be done raising interest rates. As such, should the expected Core PCE rate materialize or come in lower than expected, we may see gold capitalizing on a weaker dollar, whilst should it take market participants by surprise and accelerate, we may see gold weakening as the greenback strengthens given their inverse relationship. Nevertheless, we would also like to remind our readers of the precious metals rules as an inflation hedging instrument, which may distort its reaction to the financial release. Moreover, please note that the release of the US revised GDP rate for Q3 is also due to be released earlier in the week and may also enhance the negative correlation between the dollar and the precious metal. According to the Economic Times of India, the first batch of sovereign gold bonds, which were issued in November 2015, are set to mature on the 30th of November. According to the article, the return from the first issuance of the SGBs is expected to be around 12%, which may spur increased demand for gold in the market and as such could push the precious metals price higher should we see a significant increase in demand. However, for any material impact to occur on the price of gold, the interest by large institutions would have to be significant enough in terms of capital, which does not appear to be the case at this point in time. Nevertheless, we highlight the issue and traders may keep it in mind. Since our last report, gold's price appears to have moved in an upward fashion, having broken above resistance now turned support at the 2005 support level. We maintain a bullish outlook for the precious metal, and supporting our case is the RSI indicator below our 4-hour chart, which currently registers a figure near 70, implying a bullish market sentiment. Furthermore, our bullish outlook appears to be supported by the formation of an upward moving trend line, which was incepted on the 20th of November. For our bullish outlook to continue, we would like to see a clear break above the 2020 resistance level, with the next possible target for the bulls being the 2050 resistance line. On the other hand, the RSI being near the level of 70 may be implying that the precious is nearing overbought levels and is ripe for a correction lower. As such, for a bearish outlook, we would like to see a clear break below the 2005 support level, with the next possible target for the bears being the 1960 support base. Lastly, for a sideways bias, which appears to be a very unlikely scenario, as our S1 and R1 levels are fairly close to each other, we would like to see gold remaining confined between the 2005 support level and the 2020 resistance line.